everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Melody Wright, Albert Marko, and Tracy Shuchart. We're going to talk about U.S. real estate. Melody's been on this for a long time, and we're starting to see some kind of cracks and other things in U.S. real estate, not commercial real estate, but residential. So we're going to talk through that stuff. Overnight, today's Thursday, so overnight we saw some activities in Japan. So we're going to talk about the yen surge, the impact on Japanese markets. And Albert has this trifecta tech bonds and VIX thesis that he's been sharing with us for, I think, the past year or so, right, Albert? So we're going to talk through that. And then Tracy is going to talk through energy earnings with us. And we've got some different kind of segmented views we're going to take on energy. So guys, thank you so much for joining us. I really enjoy this every week. And it always helps me to get my mind around what's actually happening in markets. And Melody, I know we've been talking for over a year, 2 years, something like that.
Yeah.
And finally lucky enough to have you, which is really great. So I appreciate you coming on. So obviously you've been on real estate for a long time, and you've been kind of sounding alarm bells for a long time. And earlier this week, we saw existing home sales. I'm really focused on existing right now because most people have existing homes and they buy existing homes, right? So new home sales is very interesting. It's expansion of inventory, but existing, I think, is really what most people are interested in. And, we saw some changes, and I've got a chart up from your tweet looking at the combined sales for this year and the previous, I think, 15 years or something like that, with all the different colors. So can you walk us through what's happening in real estate generally, and then why existing sales and new sales, kind of what they're telling us about the market?
Sure. And firstly, thank you so much for having me on. I've been wanting to come on for some time, so
Right.
I'm excited about this and excited to meet you guys in person. And Tracy, we've spoken on the phone before or on a Twitter space, so thank you so much. So there's a lot happening. One of the reasons I've been talking about housing for so long, as you say, is that we really peaked in June of 2022. And since then, it's just been narrative. We've seen a ton of narrative trying to keep hope alive in the housing market. And what a lot of people tried to focus on was what I've called the inventory shortage myth. I wrote an article in January of 23 that said this is a myth, and there's a lot of reasons why this isn't true. And we all need to be ready for it. And I outlined some things like the 15 million vacant properties that, as the boomers retire, et cetera, and don't want to carry these increased costs from property taxes, insurance, when they could be making a nice little return in treasuries, our money market funds, like they were going to start to let those homes go. You could see that was going to happen. You also could see that, as typical, the builders went absolutely bananas, thinking, that building had not been happening. But the problem is that, people like Zillman and Zonda, they track a lot of the big national builders, but they don't often capture those smaller regional builders. They never respond to a survey. And then you look at things like our permit, the survey of construction. As with everything in COVID, responses to that survey went down. It's a very volatile series. And again, you're asking the builders what's happening in that survey. And then, the counties, I had worked with all these counties during my mortgage days. There's over 3,000 in this country. A lot of them still use fax machines. And so relying on that information is just not going to get us anywhere. And then, of course, the short-term rental passive income craze that just kind of, catapulted what had already started in 2012 with Wall Street coming in and buying up all the properties for long-term rentals. So there was a ton of speculation. There's a lot of vacant homes out there. And then the builders were going crazy. And then on top of that, you had multifamily being built, at the highest number since the 70s without the demographics to support it. So I knew something was wrong. And that's when I went out on the road and started just, visiting a lot of these towns to look at this inventory. And I could tell it was severely underreported. So I knew that, the narrative and the media was going to clash with reality at some point. It's taken longer than I would have anticipated, just I think largely because of the bank bailouts last year in March, and everybody being like, "Oh, it's all fine. We're all going to be good. It's all
Everyone's
good."
capitalized, no problems.
And because what you had in the existing market, and I'll get there, Tony, is you had a strike. You had a sellers buyers strike. They were both sitting in their respective corners saying, "No."
For like 6 months or
This
something, right? There wasn't a whole lot of movement.
Oh yeah. We're in the most abysmal sales, worse than 2008. And so the new homes, they figured that out. Connor Sen wrote a nice little article last year in March saying, if you're going to buy, go buy a new home because they're going to give you a ton of incentives. We've seen Lennar come out recently with, what those incentives looked like, which were, tens of thousands of dollars per home. And so you could net reduce that price. We know that a lot of that wasn't being captured in appraisals. Fannie Mae did an appraisal letter calling that out, saying that of the 7 million comparables they've looked at, they didn't include, in 55% of the cases, they didn't include those concessions. So put it that way, people went and they got a really good deal with new homes. And so it kept most everybody clueless to what was actually happening in the housing market. And at the same time, because of that bank saving, the builders thought they were going to be okay. And they just started pushing ahead again. And completing homes that may not have been completed. Now they're at this very large inventory glut they've got to get through. So you have the existing market, which has, if their death, divorce, default, the DOD, you do have to move. Despite what's going on, whether you have a low interest rate, et cetera. But it is completely dried up because the new home, they kind of came in and they stole any market share existing was going to have. And so, for a little bit of time, you could see in Florida and Texas that inventory just racing to market, but then the rest of the country started to join. And so we're starting to see the narrative shift. And in the existing home market, though, most people still don't believe what their home is really worth. They're still looking at their Zestimate. And as soon as that changes, as soon as there's that home in their neighborhood, which is happening all over the country, then we're going to see some loosening in that housing market. And you can see, I didn't even talk about rates, but the rates kind of falling at the end of last year is, I think, what helped propel the new home market to where it was, so that people couldn't really see what's going on. So that's a lot. I'll stop
It's
there
a
and see if
lot.
you have questions.
I
It's a
love it.
lot.
It's a lot. Let me ask. So we've heard from people for the past couple of years. Everyone's got a 3% mortgage. They're going to sit on it forever. They have all this extra disposable income. All that stuff. When I hear that, given the inflation environment, I'm not quite sure that the geniuses who are saying that stuff really understand what it's like for most homeowners. Of course, if you're a banking analyst or you're a trader or portfolio manager, this stuff isn't going to affect you. But for most homeowners, that's a factor, but they don't have a huge amount of extra cash to spend. I mean, I'm just curious of your thought on that. Am I way off on that?
Oh, no. Just talk to any homeowner. They're going to tell you the same thing. It's like, well, what am I going to do? I can't afford this luxury rental if I wanted to do that instead. I can't afford, because everything being built out there was luxury. I can't afford to move up. I'm going to get less for my money. But even Fannie Mae came out. They did a survey. They asked people, okay, what's the biggest reason why you're staying in your home? And they were very surprised that price came in as a close second to that interest. But most people were just like, well, a lot of the reasons was just because I like where I am. And so, I think anytime we try to, lay an aggregate narrative over, especially mainstream media and the financial press, who is very disconnected for Main Street. There's
Yeah.
problems there. So I think you're absolutely right, Tony. I think that it's way more complicated than that, and that this is an affordability strike. It has nothing to
Yep.
do with the golden handcuffs, which, handcuffs laced in gold, trying to make us all think that somehow that wealth effect is true, right? That we really have gained this much in wealth.
Well, and how much of, the demographics you're talking about with the baby boomers, how much of the inventory discussion is baby boomers who, first of all, have second houses that they want to get rid of, and also have large houses that they just don't want to anymore. There's a neighborhood near me, a couple miles from me, that was built in the 1980s. They're all large houses. And in the 80s and 90s, it was a booming neighborhood. And now they're all trying to unload those houses.
Right.
So, and I see this. I mean, I look around in my life to validate the economic narrative that I'm hearing. So I don't have the luxury of living in Manhattan and not seeing this stuff. So what is what I'm seeing with baby boomers trying to unload second houses or unload large houses? Is that reality? Is that what you're seeing in the data?
I think so. I think it's very difficult because on top of all of this, the data is just so bad. It is so, the MLSs, or the multiple listing services, have a vested interest in keeping that data under wraps. And
Mhm.
so, you can go on Fred, for instance, and because the people that supply that information are NAR for existing home sales, you can only get it back to 2017. So it's really difficult to get an aggregate picture of who is selling by age and things like that. Excuse me. But you can see it in these neighborhoods. Like, so
Right.
I dive in to the 80 plus markets, that I track every week, looking at what's there. But these are definitely, you can tell, second homes from conversations that I've had, either because of speculation, or it is a boomer offloading a second home they don't want anymore. Especially, this is why it started in Florida. It's that insurance crisis, it's that property tax crisis, and then of course inflation. Home ownership is just so much more costly if you need to replace anything. But that's exactly, I mean, Florida has, I think it is the biggest second home ownership market. And then, there's also foreign buyers that are starting to offload as well. Very difficult to give numbers around that, but anecdotally, you're hearing about it.
So real estate is another reason not to move to Florida or Texas, right? I mean, you really need to stay out of these markets because they're toxic real estate markets. So if you're living on the coast, these are not good places to move, right? Is that what you're saying?
As Tracy is there in Miami. But I spent 2 months down in Miami last year as well. So if you're looking for an affordable place to live, Florida and Texas right now are not those places.
Melody,
Bless you.
when it comes to inventory, how much do you think institutions like BlackRock, hoarding homes are affecting the pricing and like the supply and demand?
Yeah. So I think that, we've got a lot going on, and I know this is your area as well. It's an election year. And, I think that everybody wants to get behind that big bill. Wall Street, is stealing our homes. In reality, it's a much lower number than what people think, but it has outsized impacts in places like Atlanta and Tampa, where San Antonio, where they just hold so much of it. But what's happening right now in San Antonio and other places, again, this data is so difficult to get, but there's places you can go on the county websites to find it. They're becoming institutional net sellers. So in reality, the problem is they absolutely had something to do with the run up in prices, but that means they are absolutely going to have something to do with the reduction in prices as they sell these properties, because they don't get the homestead exemptions in Texas, for instance, and they cannot carry these costs. It just makes no financial sense. So it is definitely a factor, but it's also been politicized as well.
Yeah, I'm actually in Tampa, and maybe 2 years ago, or even like a year and a half ago, you would put in like one of the nicer zip codes for the schools districts, and nothing would pop up. I mean, two houses, and they'd be gone in a week. Uh, fast forward to a month ago, I just looked on it and just 1,000 homes just popped up there, and the prices are certainly coming down. And like you said, the cash buyers are starting to dwindle, making those interest rates bigger problem for people.
Absolutely. So
Yeah.
yeah, and so I guess I should be honest. I'm a little concerned about Tampa because because they have just seemed immune, and I think that a lot of that had to do with the job situation there. Very in what I've heard from people there, what you can different from a lot of Florida, where the only place you can work is Publix. But you're starting to see things turn in Tampa, just like you're validating what I'm actually seeing in the data.
Yeah, it's not good in Tampa. I'll tell you that right now. Even Sarasota, starting that
Oh,
area from Bradenton down to south to Venice, they've been building these mega communities. I mean, there's something to behold. I'll tell you that right now.
oh
Lakewood
yeah,
Ranch.
Lakewood Ranch. If
Yeah,
you
yeah.
go to Lakewood Ranch, like I'm hoping to get the drone there soon. Lakewood Ranch, no one would question what has just happened if they saw Lakewood Ranch. It's like 21 communities. They have not stopped building. Prices are going down, and they have so much more to build. And cell service is abysmal. It's
Yeah, I
crazy.
mean, I like their model because they build these mega communities and they have these like little mini downtowns
Yes.
all
Yep.
wrapped up into it. And Lakewood Ranch even has an equestrian and rugby, and like it's just crazy how beautiful it is.
Equestrian rugby.
They have right. They have an equestrian center, a polo center, rugby fields. I mean, like literally anything you can think of, and it's well done. But they are
But
not stopping.
location. Yeah.
They're not
And the
stopping.
other thing is location. So guess what the highest vacant building, multifamily building in China, what they were, right, what they were touting, that's now it's vacant and abandoned. And it's, I think it's a little higher than One World, Freedom Tower. Polo. That was what they were going to draw everybody in, but no one in that town had jobs. They couldn't afford to, no one could afford to live there. So it's very Lakewood Ranch, exactly the model that things are selling. But who's going to live there when you're so far from the beach? You don't, or your job. So I think it's places like that. But the thing is, if it was just Lakewood Ranch, it's just all over Florida.
Do you think were a lot of these things planned when work from home was rising, and so them
Okay.
being far away was a big asset?
Absolutely.
Okay.
Yep.
One of the things I want to go back to, Melody, is
Wouldn't that be like,
sorry, go ahead, Tracy. Sorry, go
sorry,
ahead.
being that I hate to use the word boomer, but so let's do you think a lot of these kind of plans communities were also because they thought of the influx of, say, people retiring in Florida?
Absolutely. And Dale Webb is a big builder that they just focus on those 55 plus communities. The problem is they put them in places that seniors don't want to go. And then also, the healthcare situation for seniors in Florida, believe it or not, is not that great. And so, but that is exactly, you can look in South Carolina, spend a lot of time traveling around there, North Carolina, Georgia. That's what a lot of people were building for. What were those retirees? But they're going to have to create the infrastructure to support it. That's how you know it's speculation. You go to these big, huge sites and there's a 2-lane going in and out. If those things, you never get out of your house.
Actually, so I live in a PGA golfing community, and they took out like 4 or 5 holes to build 115 homes and townhomes, and I'm just like, you guys are never going to sell that. What a terrible timing. Well, you'll never sell these places.
Wow. So I wanted to say one thing. First of all, the healthcare situation in Texas also terrible. We barely use anesthesia here. It's really awful. But also, I want to go back to your data collection issue. I was just on a podcast yesterday talking about how the feds collect data and the antiquated approaches they use to tabulate and calculate and all this other stuff. So when housing data is collected, you said that a lot of these sources of data still use faxes and stuff. So are they doing things like calling landline and taking in faxes and these sorts of things to collect this data? Is that how that happens?
That's the way some of it is described in the survey of construction. I can't tell you exactly what happens. I can only read how their methodology, but some of it does include calling the offices, going out to the builder sites, getting confirmation from them. But a lot of these forms, because there's somebody filling it out, I know how bad these back-end county databases are.
Yeah.
You've got a human looking at a number, filling out something they may not even understand they're completing. And so I don't think it's fraud necessarily or anything like that. It's a misunderstanding of what's being asked. It's not enough people for a sample size. And then on the builder side, because it's a combination in the survey of construction, you're actually literally asking the builders what that closed contract number was for home prices. They get to
Right.
fill in that number. Yep.
So, and I also, before we jump into a bunch of the data, I also want to talk about rents as a portion of CPI. Okay. Nick Timiraos from the Wall Street Journal put out a tweet last week talking about CPI and how, CPI rents were all muted in 21 and 22. And he has this chart, I'll put it up during the discussion, but it looks at how the Zillow observed rent skyrocketed by 40%, but the official CPI was muted at like 20% rise or something like that. If you're to look at, say, US rent CPI data versus Zillow rent data, which one would you look at as being more realistic?
Can I say neither?
Yeah, of course. Yeah, that's fair. That's fair. So what and why?
Well, so I believe, and I studied this a while back and I've forgotten it, so forgive me. But the CPI, I think I can't remember which one of them is only focused on same store and which one is only focused on new leases. And they're not, and so that matters. And I can tell you when I looked at that, I was like, aha. But I can't, sorry.
Yeah.
It's been a minute since I did that analysis comparing the two of those. I no longer really look at those. I have to be honest with you. I don't think we have very good sources out there for rents because I think
Okay.
people like Real Pages, they were sued by the DOJ, their state attorney generals for price fixing and rent. And I can tell you, I tracked rents with them for almost a year, realizing I was never going to see anything there. And so I just feel like at this moment, we don't have a good source for rental data, but you can triangulate it. Look at something like Apartment List. They give rent prices as well. And so I look at all of them, but I've stopped looking at CPI for, anything quite
Since you were like
honestly.
16 years old, like most sane people do.
I-
So since we don't like with all US government data, it's potentially directional, right? It's not,
Right.
there's no precision or accuracy there. It's just potentially directional sentiment gaming almost, right? So
Duh.
with that exactly, with that in mind, let's take a look at the existing and new homes, this tweet that you sent out. You said it's far below average, lowest in 25 years. Why, we've gone into this a little bit, but the black line on this combined sales chart is way below 23, 2005, 2007. Why is that? I mean, it's, we talked a little bit about that glut, but I mean, it looks terrible.
It looks terrible. And what I think is really funny, and this will be a little assignment for your viewers or community, is just go out to all the home like housing data sources and see what you can find before 2015. All of them seem to cut off at 2017 and they took away. You used to could get history from Fred. Finally, I had somebody in my community sent me the existing home data, and I was like, "Oh my God, everything makes sense!" Like it was just like, because you could
Why?
because what happens is every year we just forget the last year happened, and we look at year over year numbers, seasonally adjusted, which,
Yeah, of
as we
course.
know, it's like, so we start the year off with NAR telling us we're going to have a heck of a year, even though they're not looking at fundamentals. And then what we say are results is every month them just tweaking their model.
Right.
It's not just seasonal adjustments. They're tweaking
Right.
it because they're looking at that annualized number, which you
Yes.
don't need to in housing. That doesn't even make any sense.
Right.
And so I think what's happened is we've been in a dire situation, but nobody knows it because we're just looking at, oh, this is month over month, or this is year over year, and not in a greater context, which is what Larry Yoon and Mark Zandi did in the last crisis. I happened to be there, and we used to listen to what those guys said, and they led us right to our bankruptcy. The housing market was going to turn around every month, every season. But that's just its seasonal pattern. And it's a very strong seasonal pattern that's outside of even macroeconomic factors. The fact that we're veering off that pattern needs to say a lot to people about what's happening right now. Now, I do want to caution. I think that another reason inventory has looked low and sales look low is that we have a lot more people transacting outside of the real estate machine, which is NAR. And I think that is another thing that's going to surprise people, because would you think that we would be doing home sales less than 2008? I mean, that doesn't even kind of make sense, but that's absolute numbers.
So these
And
are
so,
buy owner sales, or?
no, if you mean, it's just anybody that sold a home, that owned a home. So
Okay.
through the MLS, because national, so it's a lot, Tony. I mean, this is, but NAR by Spin is one of the biggest lobbying firms in Washington. And so I think there's been a lot of muscle that's been put out there trying to say that social media is not coming for them, trying to say that big tech is not coming for them, hasn't already come for them, because there's a big private note sales space where people are transacting outside of these areas. And so none of our data would be able to capture that. And so I do think sales are low, but I do also think we have to realize that these data aggregators might not have the whole picture.
So in my neighborhood, there are social groups where people say, hey, I have a friend who wants to move into our neighborhood. They're looking around this price. Does anybody want to sell their house? And all that happens as a private transaction, even without a realtor.
That's right.
And so are you saying more and more? I mean, we still get these to this day. This goes to our little group. And
Yes.
I know 2 people who've sold their houses that way in the last like 3 months, and they get way above what they're asking for, all that stuff. Yeah. So so that's circumventing the, I don't know what realtors charge, 6%, 8, 10%.
Yeah, that commission fee. Mm-hmm.
But so, if you look at $1 million house, you're saving 70, 80 grand, right? And so it's just crazy. But okay, so I also want to look at delinquency rates, okay? Because you put out another tweet about that. We've had crazy low delinquency rates in the wake of COVID. Of course, the government putting a stop to things like that, and then subsidies and all sorts of things. So delinquency rates compared to the last couple of years look like they're getting a lot worse. Compared to 20 years of history, they kind of look like they're coming to a norm. So what's happening with delinquency rates? Is it something we need to like wring our hands about, or is it something that's like,
absolutely,
we do?
It's all about hide the bean or whatever the game is. I mean, because what everybody is looking at is, so they're either looking at the Fred schedule, which tracks commercial banks and shows about a 1.7% delinquency. The problem there is that since the GFC and the enhanced Basel III framework, banks really stopped lending in this space at aggressively, and so the non-banks came in, and they are now the majority of the lending in this space. And so looking at just commercial banks is not going to give you a good indicator. So then you might go to somewhere like Black Knight. They say they're the industry standard. They're owned by ICE, who owns the New York Stock Exchange. And they've touted that they had 80% of servicing. Servicing are just the loans. Your servicer is who takes your payment. Well, when you look at them in the back end database, they have about 34 million loans. We actually have according to various sources, about 84 million mortgages. So they don't have 80%. And who they're missing is important. They don't have on their system a lot of the specialty servicers, the people that do delinquency as their specialty. So someone like specialized loan servicing, or worse, someone like FCI Lender Services, who is currently at a 30% delinquency because they only focus on private note sales and delinquent loans. And so we are not, even if you want to pay like thousands of dollars to Inside Mortgage Finance for their delinquency schedules, they're going to tell you, although we're tracking a whole bunch of servicers, some of them aren't listed here. Okay, why? I mean, so it's just, this is one of the most complicated markets, and it is so big and so vast. And so we don't have all the information. And so now for this to start showing up in the most pristine places,
Right.
that is when we really need to be concerned. Yeah,
Yeah, it's complicated for a reason.
that's right.
Because there's always some sort of margin to be made when things are complicated, right? So,
Correct.
you know, and it's regulated for a reason, because there's always some capture that people can have when things are highly regulated. So,
And it's
Robert, do you have a
government
question?
backed. Right. I mean, 85% of what outstanding mortgages out there are owned by the GSEs and the agencies. So a lot of people just don't realize that. But sorry, go ahead, Tony.
You know, you've outlined a lot of problems, and I've seen stories in the last few months saying U.S. real estate is broken, and you've said a lot over the last 20 minutes or so. What are the biggest issues with the U.S. real estate market being broken? If you were to kind of have to say, these are the top 3 issues, this is why U.S. real estate is broken. What are the main issues?
To me, the fact that housing has become a casino is an issue. I could understand why a young investor, mom and pop investor, would want to have passive income. I mean, working in corporations today is absolutely miserable, and you're not getting good pay raises and things like that. So I get why people want passive income. The problem is they watch somebody on YouTube. Hopefully, a lot of them didn't. They contact me and they didn't watch anybody on YouTube, and they went out and they got into these. They went into, let's call them auctions, bidding wars, without really understanding what they were getting into. And so that is what's really, so yes, Wall Street started it, but as is typical, retail, and for, all the right reasons in many ways, got involved, and it has just become a complete speculative, frenzy. And so the speculation has to leave housing for it to right size.
And I would potentially say the corporate reasons you outlined are probably one of the main drivers. The fact that we have way too much money, way too much fiscal, way too much monetary stimulus out there is another reason, because people are just trying to stay ahead of inflation, right?
Correct.
They need
That's
some
right.
stability and security because corporate jobs aren't secure.
That's right.
And they need to stay ahead of inflation. And they're trying to do this by YOLOing on crypto or meme stocks. And, they get a windfall, then they buy a property, and then someone on YouTube or social tells them you need to buy 6 properties.
That's right.
And then,
And the banks tell them that.
Banks tell them that, and then Austin implodes, right?
Yes.
And then all the work that they've done is for nothing. So
That's right.
that's the major issue. And I guess that begs the whole, we've heard a lot past couple of years about kind of the Airbnb bust and all that kind of stuff. I mean, is that real? Is that a real thing?
Yeah, it is real, and it's just taking some time. In Austin, for instance, there's over 15,000 Airbnbs. There's no need for that. And you can see it all over. The sheer vacancy in all of these cities is so crazy. But yeah, it is real. It's taking time, of course, to play out, because a lot of these people bought 9 properties. So the first thing they did is sold 1. That didn't do
9
it.
properties.
Oh yeah, because you would go to these, they're called non-qualified mortgage lenders. It's stated income, Alt-A, whatever you want to call it, non-QM. They did these things called debt service coverage ratio loans. And the reason they can do that is there's a securitization market out there for it that wants it. And they would just say, hey, no need to put down more money, take an interest only. I mean, guys, nothing has changed. They can say these products don't exist. They do. It's at a much smaller scale than last time for the non-traditional products. But the government came right in and filled the hole with FHA, government-backed subprime, with credit scores below 580 in many cases.
Wow.
So you could even use an FHA loan to and only put down. So if you wanted a below 580 credit score, you could put down 10% and then go out and let's say, you've got some capital, you redeploy it, and then you just keep refining those proper. And the other thing they did is a lot of those all in the family sales, like you're saying, Tony, between neighbors. So a lot of these short-term rental bros would sell one property to their friend for some crazy price. That person would walk into a DSCR lender the next day and say, hey, look, this is what this is worth. And they take out a loan on it. And so it is real. It's just taking time. That's why though, Fort Lauderdale and Miami and Fort Lauderdale and Fort Myer right now are getting hit so hard because they were hotbeds for all of this.
Okay, so you've mentioned some cities. What are some cities that are
Thank
pretty
God.
stable?
I will just say about Fort Lauderdale. I'm
Sorry, Tracy?
struggling with the mute button. I was just going to say I live in Fort Lauderdale, so I am very happy this market is cooling down. I will tell you.
Great. Very good. I
Yes.
can't wait to visit your new beach house, Tracy. So,
Oh, me neither.
Melanie, you mentioned these trouble spots. Are there spots that are stable? Are there spots that are doing well?
Well, so, I tried to, it's the only places that there were only out of my 82 cities, there were only 11 cities that didn't have a decline in year over year sales. and there's no kind of indicator about any of them, but I can tell you what is actually, I call it, kind of hot right now are a lot of your smaller short-term rental communities like Sedona, Sevierville. They're selling, but what you have there is motivated selling. And so prices are also coming down at the same time. So, but there is nowhere, across the country right now in terms of like large metros that just look fantastic. And I guarantee you when people watch this, they're going to say something like, well, in my neighborhood, okay, what they don't realize is that's what their realtors are still telling them. Press your realtor on all those other competitive offers, and then go after the fact and see what really happened. So
yeah, it's crazy. Who would want to live in Sedona? I mean, I grew up in Arizona. I went to Sedona a couple of years ago. Oh my God. Like I went there as a kid and it was a fun town, but oh my gosh, it's Californians all over the place. No offense if you're from California. It's not personal. It's just,
no.
it's way oversaturated and it's just not beautiful anymore. So
yeah.
okay, so
That's what I'm hearing.
what do we look like from here? What do the next couple months look like, or next probably 6 months look like? Does it just accelerate, or are we just on this path to this very difficult market that's a slow path?
It's push and pull, right? And unless there is, so there are a ton of government programs out there. There's a new modification out. So I'll start with delinquency real quick. There's a new modification out there for Fannie Mae and Freddie Mac loans that targets a 20% payment reduction, and they're going to let you do principal forgiveness. And that is rare. And so that's out there. That's going to slow down delinquency. The FHA population, though, a lot of them have already taken the forbearance. They've already taken the partial claim, which is like the payment deferral, where you take that 18 months of missed payments and put it at the back of the loan like a silent second. They've then also, that didn't do it. So they took the combination, they did a 40-year modification. Those 40-year mods are not saving anyone. And so the delinquency picture will take a lot of time, but by June of next year, we will have material foreclosures. Now, then expect your state AG or a federal moratorium. Right now, the VA is on a federal moratorium that's voluntary, but all of the servicers are doing it. So, the politicians will get involved as soon as we hit, delinquency. Again, they've already kind of set up blaming the servicers on a lot of these things. So that's going to take a lot of time to play out. And very similar to the GFC, it's just going to slow everything down. It's not actually going to, HAMP didn't help a lot of borrowers. It'll just slow everything down. On a sales perspective, I think the builders are about to get very aggressive. They have to. They have so much inventory. They are going to have to offload it. They are also going to be begging at the government, please give me a subsidy for affordable housing. Please come
Everyone
in.
wants a subsidy. Always.
Yeah. I've got this whole built neighborhood here in Lakewood Ranch. Can't we make this into affordable housing? So all that's going to happen as well. But I honestly think you're just going to see inventory continue to grow, continue to grow. So 2025 is when I think that all of these headwinds just kind of, sort of come together. And the only thing that could save us is if we invent some awesome job that we can all go get that could sustain these prices and get trained for and do it in a short amount of time.
Why not just convert your mortgage into a student loan and hope it gets forgiven by Biden?
That's a great idea.
Why not?
I wouldn't doubt we won't be talking about something like that.
Yep.
I mean,
hey guys, this is great. And Melody, thanks for all the detail. I think, I've wondered about housing for a long time. You went into a huge amount of detail and I really appreciate it. I know the people watching appreciate it. Let's look at markets for a little while. Last night we had the Japanese markets looked pretty ugly. We've seen the JPY surge this month. We've had tech really take it over the past few days. So Tracy, with the JPY, you put out a chart earlier today, looking at how the JPY surge has hit Asian markets, gold, other assets. Can you talk us through that? Because, I'm looking at tech, I'm looking at other things, and, does all of this really go back to the Japanese yen and potentially that carry trade? Like, what's the source of the volatility we've seen over the past couple of weeks?
Yeah, I definitely think this is all related, right? As soon as we saw the strength in the yen, and we saw, the last intervention that we saw in the yen was on July 11th from the BOJ, which kind of, I think, worked. And I think it kind of pushed it over the edge where people started exiting that trade. And that has caused ripple effects across all risk assets across broader markets. And it really started with the Nikkei.
Yep.
And there are a lot of people that are very long the Nikkei. And, the stronger yen caused a ripple reaction in the Nikkei. And that has then thus caused another ripple reaction across all assets. And we're seeing this in Europe, we're seeing this in the US, we're seeing this in commodities, even sell what you have to, right?
Yep.
If you're starting to get
We see gold off, we see other Asian markets off, we see tech off. So does that tell you that people have been borrowing in yen to buy those assets? So now they have to unwrap that?
Absolutely, it's a huge carry trade. And I think really what kind of exacerbated this this move this week in particular was, it came out that the BOJ was perhaps weighing rate hikes for the next week's meeting and talking about perhaps a detailed plan to have, that's 50% have, you heard me right, bond buying over the next 2 years. And that would be a huge move for the BOJ, and that would throw another wrench into these markets. And so I think
what isn't a huge move for the BOJ? I mean, they already own 7% of the value of all traded equities in Japan. So they've effectively financially nationalized the public sector, a portion of the public sector in Japan.
Stop buying bonds, or they're going to stop bond purchases by half. That, within 1 to 2 years. And again, this is all speculation that is going on right now. We will not know until next week. But, I think that's causing a little bit of trepidation in some of these. Well,
so their yields will spike. If they stop buying bonds, their yields will likely spike, right?
Correct.
And so that means in general, they're going to have a lot more productivity in the Japanese economy to justify that kind of lending or borrowing, the borrowing that they're doing, right?
Correct. And I don't think, and again, this is why I think this is causing some trepidation, is not just this huge move in the yen, but it's looking at what BOJ policy is perceived to be for next week's meeting. And I think that's causing investors to
Yeah.
kind of reassess that trade that they're used to. Everybody's used to selling Japanese bonds. I mean,
Yeah.
that's what you do, right? Because they're the only buyers, and everybody's, the yen trade got a little bit out of control. And so now that we've seen, and I'm not saying this can't totally reverse. I mean, BOJ
Yeah.
could come out next week, disappoint everybody that's planning on this trade, and we see a complete reversal. But it is causing ripple effects across risk assets globally, not just in the United States.
Yeah, but Ueda, the BOJ head, is a terrible communicator. And it's so easy to get mixed messages out of BOJ now. The finance ministry has to come in and clarify whenever communication comes out. And it's a big problem. And ultimately, I suspect what we're going to hear from Albert is Yellen is really the puppet master who's doing this. And I don't say that cynically, Albert. I mean,
No,
you
no.
think that Yellen is behind a lot of this, or at least some of it?
Of course it is. Of course she is. I mean, she's been targeting the Chinese market for a long time now. I mean, China has just been obliterated for, just, I mean, to the point of, like, the edge of the abyss. And, she doesn't kick them over, but she certainly stopped any kind of, market stimulation that they had planned. It's just astounding to watch, to be honest with you. And I'm not a really big fan of Yellen, to be honest, but, masterfully, she did what she had to do, and
She
I'm
knows
sure
how to
she
wield
did.
control. She's
Yeah,
no
listen,
dummy. She knows
the
how to wield control.
BOJ is going to take orders from the U.S. no matter what. I don't care what anybody has to say. If the U.S. says they need something done, they're going to do it, right?
Yep.
And the Fed does this often. They test rate hikes and rate cuts with Anglosphere banks and BOJ all the time to see what happens. So
So let me ask you this from a big conceptual point of view. In China, in Beijing, they just finished the third plenum and announced some economic changes and stimulus and all this other stuff, right? So is it possible that a deal was made where Yellen stopped the decline of the yen so that the Chinese could stop pushing the CNY cheaper, and that could help them to have the funds to stimulate China and grow China instead? So basically, did Yellen help to pull China back from the abyss post the third plenum to help Chinese, say, officials look like they're in control?
yeah, I mean, listen, no one wants to see China go, into the abyss. I mean, it would
Right.
be
That would be bad
catastrophic.
for all of us.
It would be for everybody. It's no reason to have them go over the abyss like that. But the biggest problem with allowing China to stimulate their economy is inflation. You start letting China run its course, and copper, gold, every commodity under the sun is going to be up 10% the next day. So I mean, that's what the majority of the actions for Yellen were targeted, is just don't let inflation get out of control to where the U.S. would have to act.
Interesting. I want to move on to tech because, Albert, again, you've had this tech bonds VIX kind of triangle that you've talked about for quite a while. And yesterday, Wednesday, we saw some serious headwinds in tech with NVIDIA down 6%, Tesla down 10% after down days earlier in the week. They're back a little bit today, Thursday, but and then you put out this tweet that you said you're buying this dip, buying American Airlines, CrowdStrike, NVIDIA, AMD purely for political reasons. So what's happening in tech? Is that somewhat related to this JPY stuff, carry trade, or
I'm
that?
I'm sure. I'm sure that it's partly related. The earnings for Tesla were abysmal. Microsoft's having some issues also. Google missed slightly. So of course, techs were going to sell off. There's no real reason to keep tech propped up at these levels. I mean, we're way past bubble status at this point. You have
Dangerous,
Yellen
yep.
I mean, you have Yellen coming in with issuance next week. You have the DNC coming up. I mean, why would you allow like Trump to get good market news when you can do it all under the DNC and
Right.
pump this thing up to back up to like 58 or 5,900 for the election.
So-
I mean, that's something I would absolutely do, and that's something that Yellen has been doing.
Yeah, so you mentioned the DNC coming out next week, and we've had Elon Musk come out and say positive things about Trump. We had Mark Zuckerberg come out and say positive things about Trump post the assassination attempt. Do you think that this tech pullback is potentially at least a little bit political, given some of the sentiment that's coming out of Silicon Valley that's more Republican than Democrat?
Yeah, I'm sure. I mean, why would you allow them to talk like that in favor of Trump when you're definitely on the opposite side? I mean, you can hit the sell button on Tesla all day long and, dip them back down to under $200. And, I mean, not so much with Zuckerberg. Zuckerberg is, fully in the camp of the Democrats.
Absolutely, but he did have that interview where he said that Trump looked cool after the assassination attempt. So
yeah, of course, but how much is that like actually meant for just pushing Biden, getting him to push him out at the last second, which they were
true.
obviously doing. So I don't really take any. I don't really listen to Zuckerberg. I know what he does in Wisconsin with drop boxes and stuff like that. So I don't really, his Trump stuff is off the cuff and doesn't really mean anything to me.
So is this the beginning of the end for tech? We've heard guys like Belkin talk about the rotation out of tech for 8 or 9 months. He did it on here. He's talked to us about that twice. Is this the beginning of the end? Are people rotating in? I know they've already started rotating into different things, but is tech going to look different in 3 or 6 months than it looks today?
Oh, in 6 months, surely, right? In 3 months, no, I don't think so, right? Yeah, obviously you had to give the rest of the economy some sort of juice. I mean, tech was taking all of it. I mean, the Russell was slacking so badly that it was an easy trade. I mean, I think at one point it was up like 13%, and within a week it was crazy, So tech, as long as Yellen is there and as long as Powell is playing ball, Max 7 stocks are just going to perform, overperform in the next 3 months. After that is a different era. We got to see who wins and what happens after that. But I think the tech bubble, everyone clearly sees that, absurd levels on tech, like 10. I think someone was saying NVIDIA can go 10 times the valuation from this point on. I mean, really?
That would be a 700 times earnings.
Yeah, I hope that people understand how ridiculous some of these numbers are, because NVIDIA today, I think, dropped down to like 106, and it was immediately pumped back up to like 113, 114. That is the equivalent of the entire Japanese market and part of India. The value. It's like stunning numbers. Stunning numbers.
It's one company.
One company. Yeah. No. So I mean, these valuations are going to have to come back from the stratosphere at some point.
Yep.
I think 2025 is going to be rough for tech, housing.
Yep, you said that for a few months, and I'm starting to really believe you. With that in mind, let's talk about VIX for a minute, because that's one of the legs of your kind of stool that you've talked about.
Mm-hmm.
If we look to the end of Wednesday, VIX was up 22% on Wednesday and 30% over the last 30 days. So, given where tech is, where do you expect the VIX to head? I think you said in the next 3 months you expect things to rally a bit. So let's take a kind of end of year horizon. Do we expect a more volatile VIX?
No.
Sorry, do we expect more volatility before the end of the year?
No, I mean, this is typical script that they've used over and over again. They let oil accelerate to $80, $90, and then they crush it right back down to the mid 70s over and over. How many times have I been on here talking, like saying this like over and over again?
A few, but we just want to make sure people understand, Albert.
Yeah. Okay. And then they use the same thing. So they use these different tools. They use the VIX, they use oil, they use,
bonds.
Bonds, especially bonds.
Okay. Let's talk about bonds.
Okay.
What's ahead for bonds and what duration are you looking at?
I'm looking at I only play the 30-year because I know that they can control pretty much 80-90% of it. So if they're going to pump the market and pump or rally tech, it's through bonds. I mean, I think it was at 117 yesterday. It was risk. I mean, the market was selling off so hard over the last 2 days, and bonds were at 117. It was just a joke. You know what I mean? It should have went the opposite way, and it didn't. So it's just, you can see how controlled it is in the 30
You're going
year.
to see VIX crush, bonds rally, tech rally. for
Mhm.
the next few months at least.
3 months, 2-3 months for sure.
Okay, very interesting. Great. So let's move on to energy.
Can I
Melody,
can I ask
what do
just
you
a
got?
quick
Yes.
question?
Yeah,
Where
sure.
do you see that Albert the 10-year going, or Tracy? Do you guys have any thoughts on that?
I'll let Tracy do that one because I only pay attention to the 30-year only because I
Okay.
know what the Fed can control in that. So
I think I don't really have a comment on that right now. What we are seeing is, we're seeing a steepening happening right now. That could trade. How long does that last? I don't know. I think it's all going to be Fed dependent. Do they cut rates in this July meeting, or does it end up being a September meeting? And I really think that's where, the curve is going to kind of mold to. So I don't want to make any proclamations without the Fed
No
involved.
issues. Thank you. I was just curious.
well, I think the Fed cuts, and I've said this for 8 months. I think the Fed cuts in September. I don't think they can really do it in July. I mean, I'd be surprised if they did in July, but I think that they do 25 basis points in September. I've been saying this for a long time. It's just only for politics and to help the market rally. There's no real reason that data-wise to do it. I mean, they can fake whatever data they want, like GDP, which will be revised in 2 months, right, or whatever. But it's just you can see that the end of
ELS numbers.
So
yeah,
just tell
exactly.
us-
I mean, you could see these numbers are just like screaming, end of tightening has to happen. You know what I mean?
Right.
Which is already happened, but whatever.
We've seen a stellar Q2 GDP number. We just saw it today. If you believe the number, which is a huge qualification, if you believe the number, then why do we need to cut rates? If you believe the number, why do we need to cut rates?
They just need just to rally the market for no other damn reason.
Right, exactly.
I mean, there's no
Exactly.
other
There's
reason.
no, otherwise,
They shouldn't.
why are we
They should keep
celebrating
rates up.
Q2
They should-
GDP if we need to cut rates?
Yeah, I mean, listen, inflation's still a problem. They should be hiking,
Right.
In reality, but they're not
Yep.
going to do that.
Yep. Okay, guys, I realize we're running a little bit long, but I really want to talk about energy earnings, and we have the master of the energy space here with Tracy. So, Tracy, no pressure, but it's earnings season, of course, and there's always a lot happening in energy. So, energy's done so well so far this year with XLE, XOP, OIH all up year to date. On Wednesday, we had Equinor earnings. Equinor is the national oil company for Norway. They missed on revenue and they beat on earnings. What are they saying as an NOC? Like, do they give a good perspective on what other NOCs or IOCs would see in the market? Or are they very different from other NOCs, national oil companies?
No, I think this is what you're going to see overall. I think that they're going to beat expectations because they did better in Q2 on oil sales, and they were decimated on natural gas sales just because of price. And we are seeing that with rapeseal. We're seeing that, I think this is going to carry over obviously to US E&P producers, that you're going to see a loss on the nat gas side, but oil prices were very firm in Q2. And so I don't think that's going to be, I think this is kind of indicative of what you're going to see across the market. And I think it's, they're going to beat expectations. But again, nat gas is going to be a tricky sector.
But kind of muted expectations for the rest of the year in terms of producers?
So, I think they'll keep expectations low. We'll have to see how we move into Q3. Obviously, we've seen a big pullback from $84 to 78. We're bouncing now in crude oil. But still, again, and I've talked about this many times on this podcast where I said that we would be range bound.
Yep, you have.
Even though it would be a wider range, and we continue to do that. But within this range, E&Ps are going to do extremely well. Looking at the refining side, I think VLO and
Hold on, we're not there yet. Wait, hold on. We're not on I have some refining stuff.
okay.
So let's next talk about services. So Oceaneering reported on Wednesday. NOV reports today, Thursday. Oceaneering beat on revenue and earnings, but their shares fell. So I'm looking at the Van Eck Oil Services, and OIS has not done well so far this year. Sorry, month to date. So what's happening more broadly in oil field services, and why are they underperforming?
I think if we're looking at oil field services, there aren't a lot of projects going on right now, or as much as there used to be, particularly in the United States. There are a select few that obviously will continue to do well. Like Halliburton is going to do well. You'll have SLB will continue to well. But there just aren't a ton of projects out there right now. I think that's why oil field services are kind of pulling back here. And if you look at what's going on in the United States, and in particular, nobody's really drilling new wells here. They're all using duck wells. And so, it's kind of putting a little bit of pressure on the service industry as a whole. I don't really expect that to change much, to the end of the year, to be honest.
Yep, at least until the election, and that all depends. A lot of this seems to be on hold, right? Until then. So, okay, and then refiners. So we have Phillips 66 reporting on Tuesday. PSX has done okay this year. They're up, but they were really up in April. After April, they kind of took a dive. So, summer driving season has been kind of slow. That's really cut into refining margins. So what do you see for refiners for this earnings season and into the back half of the year?
I think they'll do well. I think VLO will beat. I think MPC will beat. Probably not by as much as people thought, but refining margins were still pretty firm for the most of Q2. I think they'll tighten up again going into Q3 and Q4 for the back half of the year. So I think refiners will hold up well. And so, I kind of like buying on dips for refiners right now.
Right. Okay. Guys, this has been a great show. Thank you so much. Melody, thank you so much for joining us. Albert, Tracy, thank you so much for all your insights. Really appreciate this. Have a great weekend and have a great week ahead. Thank you.
Thanks, Tony.
Thank you. Thanks, guys.